Hi everyone, this is Anand Radhakrishnan, Chief Investment Officer, Equities from Franklin Templeton, India. In this moment, first and foremost, I would like to acknowledge the deep pain and the distress, financial distress, that our decision to shutter 6 fixed income funds have put the investors into. It is not an easy decision for us to make, and as told earlier by some of our managers and leaders, that we have been seeing large redemptions from our fixed income funds, and the current decision was a consequence of unprecedented redemptions within a very short periods of time and the inability of the market to provide us liquidity. However, all is not lost is what I believe. We have undertaken to systematically unwind our investments and repay the investors after repaying our borrowings as and when papers mature, as and when we create liquidity by selling these papers. So we stand by that commitment to investors, and while it is a painful decision, there is nothing to get away from our commitment, and we are all committed to ensure an orderly wind down of these funds. Beyond these fixed income funds, it is time we focus on what we have built over long periods of time elsewhere, and what do we want to do with that. Today we manage little more than 40,000 crore of assets in equity funds. About 6 main equity funds and a few hybrid funds, tax fund, and a couple of thematic funds. And some of our funds have been there for a very long period of time. Few have completed 25 years of existence and have gone through various business and market cycles. Right from the year 1993 onwards, since the first fund was launched, we have seen multiple economic and market volatilities, whether it is Southeast Asian crisis, dot-com bubble, global financial crisis, etc. And the equity team in its current form and its earlier form have kind of evolved through these cycles, learned from them, and have embedded some of the key lessons from market volatility, and have incorporated that in our investment framework. So it is very important at this moment to be aware of the longevity of our funds, the tenure of some of them, the stellar performance of some of our very long funds, and the value they have added to the clients. More at this moment, I would like to thank the investors for reposing faith and trust in Franklin Templeton's equity team for so long and have traveled this journey with us. There are few points I would like to make at this juncture regarding what is the way forward. First and foremost is to reinforce how do we operate. Equity team within Franklin Templeton is independent. Globally, as well as locally, investment teams in Franklin Templeton are aligned asset class wise. Unlike some of the fund houses where they have common heads for equity and fixed income, here in Franklin Templeton, we do have separate heads for equities and fixed income, and both report to different supervisors globally, and do not work in any form together. They take decisions independent of each other and more often differently. For example, our fixed income team may not have lent any money to companies that we own, and we may never own companies that they lend to. So we do take decisions very independently and very differently. Just to give an example, even when Franklin Templeton acquired Kothari Pioneer, they let the team operate from where they were, in this case Chennai, and build their franchise from there. And that is true for everything else. Wherever Franklin Templeton built businesses globally through organic or inorganic manner, they have followed the principle of letting the investment team of that particular group operate independently, autonomously, with their own set of principles and philosophies. Only common support functions like accounting, sales, marketing, customer services were integrated, and specific functions like investment is kept separate and in different silos. So to reinforce the point is that while the organization is one, the teams are independent, and that I think is I would like to reiterate as the primary point. The second point is that what is our investment philosophy? Our investment philosophy has been and is and will be different from what we followed elsewhere in our organization. Our primary investment philosophy is to invest in quality companies that have been growing sustainably over long periods of time. These you can call this as steady compounders or stable companies which are less volatile in its operations. More often, while we have eschewed or avoided investing in momentum companies which are exhibiting very high growth for a very short period of time, precisely because we think that it is not a sustainable investment strategy for our investors for long periods of time. While it may give very short-term returns, we do think that the investment strategy is not repeatable if one follows a momentum or a high growth, high return strategy. So it is very important that we follow a consistent philosophy of quality and sustainable growth, and that is the primary anchor. Second anchor in our philosophy has been staying true to the mandate. That is, every fund needs to be managed as per the mandate given to us, and they are supposed to take intended risks and achieve intended consequences. In other words, the risk that we take should be commensurate with the promise that we made to the investors for the fund, and the consequences also should be reflective of that risk. Anytime we put the risks or consequences ahead of this principle, we would be starting to deviate from that mandate, and I am glad to say that none of our funds or fund managers have deviated from these principles in long periods of time. So equity team's philosophy is different, is the second point. The third point is our funds remain diversified. As many of you know, equity funds are under different category like large cap, multi-cap, mid and small cap, thematic funds, focused equity, etc. All these strategies are managed independently and differently true to their mandates. Unlike the fixed income funds, where 6 funds had a lot of overlap in their strategy and risk return profile, equity funds remain significantly diversified. Wherever overlaps are there in terms of our holding, they are as per the mandate and as per the market opportunity. Very rarely we say that what is good for the goose is good for the gander, or what is good for one fund is automatically good for the other fund. What is good for a fund is subject to the fund's mandate, and what is good for another fund is as per that fund's mandate. Not only the philosophy of managing these funds are diversified, the management, day-to-day managements of the fund are diversified as well. Each fund managers lead a particular strategy and lead those funds and shape up those strategies within our strong investment philosophy and framework. For example, I, as a CIO, run a multi-cap strategy and a value fund. Janakiraman Rangaraju runs a mid and a small cap strategy. Roshi Jain, our other fund manager, runs a focused equity strategy and blue chip strategy. Lakshmikant Reddy runs all our hybrid strategies along with large and mid cap and ELSS strategy. As you might have noticed, and we have always said it in the past as well, we encourage different views within the team, slight different approaches to investment within the team, though within the larger framework of the investment philosophy, and encourage fund managers to disagree and dissent with each other and shape up their investment for that particular fund. This, I think, is very, very important, and we have consciously built this so that there is not excessive group thinking, there is not excessive trend or grouping towards a particular kind of risks. And not only when investors buy our funds, not only they are buying different fund categories, they are also buying different fund managers and different fund manager styles within our overarching philosophy of quality, sustainable growth, etc. So this is an important point I would like to highlight, that we remain diversified even within our team and to ensure to avoid lots of group thinking. The fourth point, important point, is our processes. We take a lot of pride in saying that we have built a very good, robust research and investment team. Most of them have been growing internally, and our process is anchored towards fundamental researching our companies and making picks sector-wise, stock-wise, etc. Our analysts who lead every sector come up with a curated list of companies and recommend strong buys within each sector. They not only recommend buys and sells, they also run their own model portfolios, and they use their model portfolios to drive ideas through the firm. They are measured by the performance of their model portfolios, how well their recommendations are functioning and contributing to the overall fund house's performance. Fund managers pick and choose from the analyst's best ideas from analyst's model portfolio using various other overlays like risk, liquidity, suitability of that idea to that fund mandate, their own judgment of market cycles, sector cycles, etc. So that is a second overlay on top of analysts' selected model portfolio. And the way we apprise our own internal people is based on every level of this value chain, so that quality and processes are embedded in our investment framework. Our own company, internal company appraisal framework is differentiated from others and is continuously refined. Here I would like to take an example of a quality framework which we have evolved internally over periods of time. Every company is ranked in quartile 1, quartile 2, quartile 3, quartile 4 based on various quality parameters. Some of these quality parameters include the ranking in the ESG, the longevity of their management, the consistency of their capital allocation decision, their return on equity, return on capital employed, the minority shareholder friendliness, etc. So any of our portfolios, we can easily know what are the top quality companies that we have, what are the second quartile quality companies that we have, etc. And we constantly make efforts to refine and reduce our exposure to quartile 3 and quartile 4 companies, especially quartile 4, where we are significantly having doubts about our quality issues. So clearly we lay a lot of emphasis on our investment process, and we want to ensure that we follow robust investment principles and sincerity to ensure that the companies that we pick travel the cycles a lot more robust than companies we don't pick. So our processes are extremely robust. The other next point is our approach to performance and risk. We definitely and never place performance ahead of the process. Many times people give me feedback that have you not taken this decision and that decision, and I often acknowledge that we have erred on the side of caution. We have committed many mistakes of omission and less mistakes of commission in our long history, and the reason is between short-term performance and long-term consistency will always play for long-term consistency, and we believe that time will test things, and only companies and businesses that can come out of this will lead to desirable outcome. Not only our risk philosophy towards risk is robust, we also bet size our risks suitably. Most of our big bets are on proven, steady businesses with long track record. That doesn't mean we do not take risk in any form. Whenever we find a suitable opportunity, we do invest money in that. It may be untested, unproven, but we mitigate risk by keeping the bet size small and growing and watching them over a period of time, and increasing the bets only when we develop large convictions that they are growing consistently. So while no one desists from taking risks, I think there is a framework that we use to ensure that the risks are taken according to the opportunity and suitably. Not only we do that, we also learn from our mistakes. Needless to say, even we have committed investment errors in the past. But the important thing that we believe is that we learn from those mistakes and incorporate suitable changes in our approach. There are companies that have failed that we have held in the past, and many of you would know some of these investments as well. And it is every time we make one investment and we lose money in that, it is deeply painful for individually as well as collectively as a team for making that wrong investment. And we get back to the drawing board and see what went wrong. What are the things we could have done differently in that idea, and we try to incorporate that. And this willingness to admit to mistakes, introspect and reflect that in our investment framework is an important quality of our team, our fund managers and our analysts. I feel proud to have a set of professionals who strongly believe in that ethos and culture, saying that admit the mistakes, learn from it, and do not repeat it. And I think that is the final point I would like to make on our investment team in equities. To summarize, we are different. Our philosophy is different. We are independent. Equity teams do not mix with other teams, and even our location is different. And our processes are robust. Our funds are diversified, and our approach to performance and risk is extremely robust. There are some people who express at this moment doubts about, is FT leaving India? Why should we trust what you are saying, etc. I do understand the angst and the anxiety of the investors and the anger. And as told by our senior leaders, FT remains committed to our investors in all funds, especially so of equity funds now, and would like to do all the things that is possible to ensure that their interest is not compromised. We deeply recognize the fiduciary duty that we owe to our investors and would do everything that is possible to ensure and protect the interest of our investors across all asset classes, especially so in equities. The reason why people should rely faith on equity team at this juncture is because of our long track record and our commitment and independence to ensure that the interest of the investors are not compromised at any cost. With that, I thank you for listening to this audio podcast. If you do have any more questions, please write to us at service@franklintempleton.com. Whatever additional questions you have, I will be very glad to come back to you again and answer all of them in my subsequent audio messages. I also wish to place at this juncture, it is very tough for us to reach out to every individual investors, distributors and advisors because of the challenges posed by the lockdown. So once the lockdown is lifted, I will make me and my team will make personal efforts to reach out to all of you and face the questions and the queries and the concerns that you have on our equity funds, and will be happy to give as much information and possible and be as transparent and open as we can be in our approach. Thank you again for listening to this podcast.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.